From the far reaches of Southeast Asia, investor attention was grabbed by a super app company that provides a breadth of services from food delivery and ride-hailing to digital financial services. That company is none other than Grab. It was founded in 2012 by Anthony Tan Ping Yao and Tan Hoi Ling and is headquartered in Singapore. Operations span 8 countries: Cambodia, Indonesia, Malaysia, Myanmar, the Philippines, Singapore, Thailand, and Vietnam, with its ecosystem allowing millions of people to access driver and merchant partners all through a single app. Users can do a whole lot of grab and go since the platform lets them order food or groceries, send packages, hail a ride or taxi, pay for online purchases, or access services like lending, insurance, wealth management, and telemedicine. Grab's business is divided into 4 segments: deliveries, mobility, financial services, and others. In the financial services segment, Grab offers digital banking services through GXS Bank in Singapore and GX Bank in Malaysia. With over 40 million monthly transacting users, Grab's platform is highly engaged and demands merchant partners that range from local entrepreneurs to multinational franchises and lifestyle service providers. Though, as you can imagine, this can be challenging, as demonstrated by Grab reportedly pursuing a deal to acquire its Indonesian competitor GoTo. The acquisition would mark a significant development in the Southeast Asian ride-hailing market, but the deal is still subject to successful negotiation of terms and securing necessary financing. A potential deal could value GoTo at around $7 billion, and GoTo would sell its international unit and entire operations in Indonesia, except its finance arm, to Grab. However, the deal terms are not finalized and could change as the 2 companies are still in negotiations. Grab and GoTo have had on and off merger talks for years, but competition concerns have previously hindered a deal, and regulators in key markets in Southeast Asia may impose strict scrutiny on the potential merger. The 2 companies require more time due to conditions proposed by the Indonesian government, which is concerned about market competition and job welfare. Public opposition has also emerged, with protests by ride-hailing drivers fearing job losses and price hikes if a Grab-GoTo merger creates a monopoly. The government has indicated it wants the merged entity to offer better benefits to drivers and ensure Indonesian majority ownership of GoTo, though no specific plan has been outlined. Despite reports of acquisition talks, Grab has publicly denied any discussions or definitive agreements with GoTo. Grab recently raised $1.5 billion through a convertible bond offer, stating that acquisitions are among the intended uses of the funds. GoTo, currently valued at $4.4 billion and largely foreign-owned, has also denied having reached any agreement with another party. A merger could help both companies, which have been posting losses since their IPOs, reduce costs through operational efficiencies. Grab, itself valued at around $19 billion, has emphasized organic growth and share buybacks while continuing to dismiss any merger plans with GoTo. Though if the combined entity does become a reality, it would dominate around 85% of the $8 billion ride-hailing market in the region. Indeed, such market share is undeniably attention-grabbing, despite the immense hurdles that need to be overcome. That's why there are always at least some investors that maintain a positive outlook on Grab's ride-hailing, food delivery, and digital payments business, especially when strong revenue growth of 17.3% took place over the last year, alongside a solid market capitalization heading to the $20 billion range. As Grab continues to expand its super app ecosystem across Southeast Asia, it also recently raised $1.25 billion through convertible bonds for share buybacks and acquisitions, having already repurchased $226 million in shares. Then, aside from talks about GoTo, a more definitive move has led to Grab announcing an investment commitment to WeRide, expected to close by the first half of 2026, as part of a broader partnership to accelerate the rollout of Level 4 robotaxis and shuttles across Southeast Asia. The collaboration will integrate WeRide's autonomous driving technology into Grab's fleet operations, focusing on optimizing vehicle dispatch, routing, safety monitoring, and overall efficiency. The partnership aims to support large-scale deployment of autonomous vehicles in the region, in alignment with local regulations and public readiness. Building on a memorandum of understanding signed in March 2025, the agreement also includes plans to train Grab drivers and local communities for future careers in the autonomous vehicle industry, addressing labor shortages in the transportation sector. For shareholders, belief in Grab's long-term potential depends on its ability to achieve sustained growth in Southeast Asia's digital economy while managing thin margins and intense competition. The key short-term catalyst remains its ability to improve margins by curbing promotional spending. In the long term, ongoing pricing pressures and the need for strict cost discipline continue to pose the greatest obstacles to earnings momentum. However, reaffirmation of its 2025 revenue guidance at $3.33 billion to $3.4 billion and its recent return to profitability are notable positives. For more on Grab, other stocks, and crypto, follow Ascencore. Thanks for watching and have a nice day.